We're now ready to begin preparing what's known as the statement of cash flows using what's known as the indirect method. And if you need to, pause this video, go and get some paper and something to write with so you can actually go through the steps of preparing what's known as the statement of cash flow. Okay? So with the indirect method, we'll first look at the operating activities section of the statement of cash flow. We're going to convert what's called the accrual-based net income over to a cash-based net income. So we look at all of our different type of operating activities, and we're going to identify from those, based upon their changes, whether we have an increase or a decrease in cash from our operating activity. We'll look at the current year's income statement, as well as a comparative balance sheet. Comparative means we're going to have data for more than 1 year shown on what's known as the comparative balance sheet. And we'll look at select additional data in order to prepare the operating activities section of the statement of cash flow. All right. We'll look at the changes in our non-current assets and our non-current liabilities. And these changes are going to impact the investing and the financing activities section of the statement of cash flow. We're going to also disclose any non-cash transactions that are considered to be significant. So again, we'll still look at the comparative balance sheet and additional information that will impact our cash account. All right. Then we'll compare the net change in cash on the statement of cash flows with the change in the cash account reported on the balance sheet to make sure the amounts agree. So recall that your classified balance sheet will show your ending cash balance. If you have a comparative balance sheet, you will see the beginning cash balance, which will be the ending amount from the previous year, and then you will see the ending amount for the current accounting period. We're going to compare that ending balance or the beginning balance and ending balance on a statement on the balance sheet to the ending and beginning balance shown on the statement of cash flow, and those two amounts must equal one another. All right. Now, companies favor the indirect method for two reasons. First, it is easy to prepare and less costly. Okay. So again, I mentioned before, over 90-something% of all public corporations use the indirect approach. And this method focuses on the difference between net income and net cash from operating activities. So pretty much we focus on the difference between an accrual-based net income compared to a cash-based net income. All right. So here we have an income statement for a computer services company. It shows their sales revenue, and it shows all their expenses for this particular accounting period. We're going to use the income statement as well as a comparative balance sheet and some additional information in order to prepare our statement of cash flow. All right. So here we have a comparative balance sheet, and we're first just looking at the assets section of the comparative balance sheet. Now pay attention. I want you to focus right now strictly on the cash account. Again, focus strictly on the cash account. This was the cash balance on 12/31/2016. This is the cash balance on 12/31/2017. Cash went from $33,000 to $55,000. Therefore, when preparing your statement of cash flows, you know already that you must show an overall increase in cash in the amount of $22,000. The question is, what type of activities caused the cash account to increase? Did it come from operating activities, investing activities, or from your financing activity? But I love this statement because once again, you already have a check figure. You know, once you're done, your cash flow statement must show a beginning balance of $33,000. It must show an increase of $22,000, and it must show an ending cash balance of $55,000. Now, what we're doing, we're showing the change from all of our assets from the beginning of the period to the end. We're showing whether they increase or if they decrease and by how much. We're going to use these changes to prepare the statement of cash flow. All right? So I get a little background information. For the operating activities section, we'll focus on the change in current assets and the change in current liabilities. For the investing activities section, we'll focus on the change of our long-term assets such as PP&E, land, building, and any types of long-term investment. So you ready to start working? Okay, let's go. So here we see the liability section of the balance sheet as well as the equity section. And again, notice that we're showing both 2016 and 2017. We're showing for each account the change in their balance, whether for each account the balance increase or if the balance decrease. If you need to, you can write down these account titles and show their change from the beginning of the accounting period until the end of the accounting period. All right, here we have some additional information. They said that the amount for depreciation expense was comprised of $6,000 for the building and $3,000 for the equipment. We sold equipment with a book value of $7,000 that cost us $8,000 less $1,000 of depreciation. We sold for $4,000 in cash. We issued $110,000 of long-term bonds in direct exchange for land. So that's a non-cash activity. A building cost on the $20,000 was purchased for cash. Equipment cost of $25,000 was also purchased for cash. And we issued common stock for $20,000 cash. And we declared $29,000 and paid out cash dividends. I was taking a sip of water. Now we're going to use the comparative balance sheet. We're going to use the income statement along with this additional information in order to prepare the statement of cash flow. All righty. We'll first begin with the operating activity section of the statement of cash flow. We're going to convert from an accrual-based net income over to what's known as a cash basis of net income. To begin preparing your statement of cash flow, write this down. You're going to first begin with your accrual-based net income. That is shown on the income statement. Again, begin with your accrual-based net income. Get some water, which is shown on the income statement. We're going to add to that any non-cash expenses, such as depreciation, amortization, or depletion expense. If you think about depreciation, this is a non-cash expense because when we make the adjustment for depreciation, what do? You debit the expense account and you credit accumulated depreciation. Notice that cash is not involved when you're recognizing depreciation expense. We're trying to go from an accrual-based net income to a cash-based net income. Recall with the cash basis, you recognize revenue once cash has been received, record any expenses once cash has been paid out. But with the accrual-based net income, you recognize revenue once it's earned, regardless of whether we paid cash out or not, or received cash or not, and you record your expenses only once cash, you record the expenses once they have been incurred on the accrual basis. So to summarize that, when you're converting from an accrual-based net income to a cash-based net income, any non-cash expenses recorded on the income statement are added back into net income. Why is that? Because on the accrual basis, they were subtracted to get the net income amount. We're trying to now determine the amount of net income using the cash basis of accounting. You will deduct any gains that's shown on the income statement and add any losses shown on the income statement to go from your accrual-based net income to a cash-based net income. And we'll explain that in more detail a little bit later. We'll then look at all of the changes in our non-cash current asset. Notice it says non-cash, and our non-cash current assets and all of our current liabilities. Based upon whether these accounts increase or decrease, that will indicate we're going to add them to the accrual-based net income or subtract them from the accrual-based net income. Ready to get started? Let's go. So for our example on the income statement, we had an accrual-based net income for $145,000. We're going to add back into that the amount of expense for depreciation that was shown. Remember, it was $6,000 for the building, $3,000 for the equipment. We're going to add back in that $9,000 for depreciation because that is a non-cash expense. Next, on our income statement, we had a loss on disposal of a planned asset. So think back to chapter 10. What will cause us to have a loss on disposal of a planned asset? It means an asset was sold at a price less than its current book value. Again, an asset was sold at a price less than its current book value. That loss is subtracted to get the net income on the accrual basis of accounting. However, there's no cash involved in the loss on disposal of planned asset. And because we're going from an accrual-based net income to a cash-based net income, any loss on disposal that's shown on the income statement is added back to net income in the operating activity section to determine the cash-based net income. On the flip side, if there's a gain on disposal, that means that an asset was sold for a price higher than its book value. So in this situation, that gain doesn't mean there's a cash gain because of that. It just means that, again, the book value was less than the actual asset selling price. So if we have a gain on disposal, it's deducted from your accrual-based net income to calculate your cash-based net income. Now let that sink in for a while. Let me show it to you. So in our example, we had a loss on disposal of a planned asset for $3,000. So we're going to add that back into our accrual-based net income to calculate our net cash provided by operating activities, also known as your cash basis net income. Okay, we're going to stop here for now and going to come back and continue our discussion on preparing the statement of cash flows using the indirect method.